Ashish Shanker, he's the head of investments, Motilal Oswal Private Wealth Management. Mr. Shanker, thank you so much for taking time out. And before we dig deeper into Motilal's anti-fragile portfolio, just want to understand what is your assessment of this up move that we've seen on the markets, and also the kind of indicators that you are picking up on the macros, the earnings, and the overall picture that you're getting.
Thank you very much. It's a pleasure to be on your show. So first up, I think there are several factors which have contributed to this market up move. First, I think in March, things were very uncertain and people were very confused about how this will impact earnings and what kind of widespread destruction it will have within the economy. However, 4 months now, this pandemic has, kind of evolved. People are realizing that the listed companies have handled this extremely well. In fact, one thing that all the earnings have shown us is people have been very quick to do cost cutting. People have adopted business models. So the destruction in terms of earnings has not been as bad as what everybody expected. Second, if you look at the top 200-300 companies in the listed space, they've gone into this pandemic with reasonably decent balance sheet. In fact, if you look at the last 2 years, India Inc. has largely been deleveraging. So that is also ensured that the damage is not permanent for many companies. And in fact, a lot of the listed companies have gained market share during this period. And the last thing is there is abundant liquidity unleashed by the Fed and RBI. And interest rates have come down to record low levels. So today, if somebody were to go and do a fixed deposit, right, the returns are sub-inflation. So that is also prompting this move into equities. And my sense is if things are open up as they have been, then probably you could sustain, maybe you could see a small correction sometime in the near future. But increasingly, people are realizing that probably it was a one-quarter phenomena and things will gradually come back to normal. That's the feeling I get when I talk to people.
Okay, at a time like this, I mean, talk to us about how one can make their portfolio anti-fragile. Of course, we'd also like to get in a sense of your analysis that you've done about demand, about economic recovery, and the kind of equity returns that one should look at as part of the anti-fragile portfolio. Give us a sense of how that really panned out.
This is an interesting concept, and obviously this term was coined by the famous author Taleb, who's also coined terms like black swan and skin in the game. Now, how this concept came about in our minds was when in April, we were looking at some of the portfolios that we offer to our clients to do a check in terms of, how much leverage those companies have, in terms of what are the ROCs these companies produce. Essentially, what we were trying to see is which are the companies which will go through this crisis period with ease and probably come out better on the other side, because we believe these are the companies which have the maximum opportunity to take market share gains, and some business models which have adapted will also see the earnings trajectory move to a different level. So when we were doing this, we figured out that essentially we are looking for what Taleb calls anti-fragile companies. Now, just to elaborate on this concept a little more, on one side, clearly you have fragile companies, and which is self-explanatory. These are companies with large amounts of debt on their balance sheet or business models which are not suited for this kind of a crisis. And typically sectors like hotels, or travel may fall in this space. The other set of companies are what we call robust or resilient companies. Now, these are companies which have resisted this storm and have not seen too much damage on earnings or even on their balance sheet. But essentially, we're not looking for resilient companies. What we're looking for is anti-fragile. Anti-fragile, these are companies which have actually gotten better during these periods. And when we dug deeper, we found that largely there are 3 sets of companies in the anti-fragile segment. The first set of companies are companies which were doing well pre this crisis, but the crisis has just accelerated the business growth to a different trajectory. So classic example being sectors like telecom or insurance. I mean, they were doing well pre-pandemic as well. But during this pandemic, the importance of their products have really got highlighted and they're accelerating. The second type of companies are companies where you've seen changes in their product mix because of habits of consumers changing. So you have a lot of consumer companies which have been resilient, but there are certain type of companies which have really got massive demand across categories like processed foods, because a lot of people are sitting at home, they're ordering in. So there is a demand to have better kind of processed foods at home itself. So this is one example of companies which are actually accelerating because of product level habit changes. Pharma and healthcare, you can put it in the same bucket because the attitude towards healthcare for a lot of people is changing rapidly. The third set of companies are the most interesting, to be honest. These are companies which have probably borne the brunt of the lockdown in April and partially in May, but they have evolved their business models, and which has made them more resilient, and they are in a position to not only get market share gains but also benefit from habit changes. So companies in the ready to eat food segment, I can name a company like Jubilant Foods, for example, right? They've always modeled their business around delivery, and they've not been dependent on people like Zomato or Swiggy, which take away a lot of the margins of the restaurants which have pivoted to delivery. So these businesses are really coming out better. So there was a demand from a lot of our clients to build a portfolio from scratch around such names. And we believe that a lot of these names have a long runway for growth. The whole idea is not to buy companies which have only benefited during this period and have extraordinary profits, but have runway for growth. That's how you can, compound the gains.
Okay, fair point. Mr. Shanker, I'm just going by the top-down analysis. You factored in demand, economic value, moats, and equity returns. So which are some companies, if you want to highlight, or some sectors where there is an overlap and sort of a balance of all of these factors coming together?
Right. So I think in the three categories, I did mention certain sectors, and the names are reasonably, pretty obvious. So we are looking at companies which can sustainably generate ROEs of greater than 12%. Maybe this year, maybe an exception for a few names because, the lockdown period has brought down utilization levels. But we are looking at companies which can sustain at least a greater than 12% ROE. And we are also looking at companies which can, let's say, grow profits by at least 20-25% over the next 3 to 4 years. Now, if you look at some of the sectors which are exhibiting this kind of behavior, you have telecom. And in telecom, basically, you have two names to pick from, which will qualify in these criteria. So depending on the preference of our fund managers, they would look at either one of the two names. Then in the second category, like I mentioned, you have insurance companies which qualify in the second category, where they were doing well before pandemic, and after the pandemic, you've seen an acceleration in interest for these products. So there are 3-4 private insurance companies that we like. The leader obviously is our obvious choice to come into the portfolios. These are high cash generating companies, and we are also looking at very low level of penetration for this business, and they can gain market share for long periods of time. Then you have pharma and healthcare. There are certain niche names which are not only strong domestically, because we also believe that as per capita of the country increases, the general spend towards pharma companies will go up. There's one interesting insight that we found, that last year, the total amount of excise paid alcohol sold was more than the drugs sold in India, which was quite surprising. In most countries where per capita incomes are higher, pharma is a much larger spend of the household wealth. So we believe that should also play out. Then there are consumer discretionary names, which probably were in a lockdown in April and bulk of May. But a lot of these companies are coming out with much cleaner balance sheets. I mentioned one name, which is Jubilant Foods. Then you have a lot of the white goods manufacturers, which are seeing increased demand. And one of the names in our portfolio is Voltas there. So many such names are appearing in our list. I mean, we made a universe, but obviously finally what goes in is a function of the valuations and the growth adjusted valuations. More importantly, we look at the PEG ratios from a valuation point of view to decide which stocks are more attractive at that point in time.
Okay, before we let you go, Mr. Shanker, during your analysis and the research you all have put together, any themes that appear risky or fragile at the moment that you would like to warn investors against?
See, obviously the names which are clearly fragile are sectors where demand recovery is going to take much longer in spite of things opening up. So the obvious names are travel. You have names in the commercial vehicle segment is going to take much longer to recover. You have themes like hotels, and it's not just sectors, but also companies which have debt on their balance sheets and have large interest outgoes. So those companies will take much longer to come back to normalized ROEs, and those are clearly fragile at the moment. Other than that, you have to go down at a company level and see, which companies which are getting better and gaining more market share during this period. I think those are the ones which will come out winners from this crisis.
All right. Okay. Thank you so much once again, Shankar, for taking time out and talking to us about in detail about this anti-fragile research that the company has put together, the anti-fragile portfolio as well. Moving on.